Hello, this is Brian Shannon from Alpha Trends Blogspot. It's Monday, the 12th of November, 2007, and the markets got crushed once again today. S&P 500 finished with a loss of $1.15, down about 0.8%, and that actually held up much better than the rest of the markets. You know, we look at technical analysis, we look at things like moving averages, and we look at Fibonacci, and things that try to, what we do is try to look for structure within what might appear to be random. And I've been saying for a while that we have to look at this market very carefully, and we have to remember that defense wins the game. It's times like this that, you know, these tools like Fibonacci, you look for potential levels of support at a 2/3 retracement. You look for the 200-day moving average to potentially hold as support. But when those things break, it means there's something wrong with the market. And it doesn't mean there's something wrong with Fibonacci or the moving average or technical analysis. It means that the market is still declining, and to stand in front of it based on something is, you know, seemingly random as a moving average or a Fibonacci level just doesn't make any sense. What we want to use those levels for is an inflection point, an area to gain our interest so that we can look at shorter term time frames and see if there's evidence of buying. And when we look at the shorter term time frames, we still see what? We still see a declining 5-day moving average. We see lower highs. We see what was looking like support at that 145 level, but then that got broken late in the day, and that's the way it's supposed to happen, is the more times that support is tested, the more likely it is to fail, just like we saw up here at the 148 level. So now this market continues to get more oversold each day, and it appeals to people's greed and reason, and the market doesn't trade on reason in the short term. As Warren Buffett says, in the long term, it's a weighing machine, but in the short term, it's a voting machine, and people vote based on emotions a lot of times. So we can look at this market and say it's still doing, though, what it's supposed to do. We were looking at this head and shoulders pattern on the 30-minute time frame. Gives us about a 6-point height to this pattern, and if you subtract 6 points from the breakdown point, it still leaves us with that potential target down near 143. Now again, with technical analysis, it doesn't mean you just sell short here and put in a buy order at 143. Instead, you monitor the short-term action to see if the action is unfolding as you would expect when you see this pattern develop. So far, it is. It's making this series of continued lower highs and lower lows. Now it's going to have to get back above. It's got a lot of potential resistance levels all the way back up. And you look at some of these market leaders. I took a good look at some of them over the weekend, like Apple. And people were looking at buying at the 50-day moving average. And what I warned there was, don't buy there. Look to see if there's evidence of buyers at that 50-day moving average, and there was no such evidence. We still see this stock continuing to just get hammered, and the PE keeps dropping, and it doesn't make it more of a value. Something that I've always thought about in terms of, you know, value stocks and value funds. Value is a perception. It's not really something that can be measured, I don't think. It's just, what do you value it compared to what somebody else values it? Anyways, maybe not a good tangent there. But the point is, this market continues to act very weak. The semiconductors completely obliterated that 450 level that we thought might act as support. And if you go back and listen to the archives, what I was saying is 450 looks like potential support. And it's always potential. You don't know until after the fact. The fact is that support level did not hold, except for maybe just a couple hours in here. That support broken, did act as resistance, and we're back to a series of lower highs and lower lows. As long as this 5-day moving average is declining, you give the benefit of the doubt to the sellers in the intermediate term. For the IWM, this market was the one that gave us the most reason for concern, you know, for the last couple months, and it's broken this uptrend line as we've seen. It looks like maybe it's heading down towards this a test of the prior lows. The prior lows down here were about 73.20 or so, and looking at a short-term time frame, the 30-minute time frame, you can see it got back above that 5-day moving average today. It made a slightly higher high, but again, you don't trust these little higher highs while we still have a market that's in an overall decline. These rallies are going to typically fail, and if the market gets more sold off, This 78 level, 78 to 78.5, is going to continue to be a very critical level for the Russell 2000. That's the level we've been looking at. That was prior support. 78.40 was the actual number we're looking at, but I'm going to just say 78.5. If it can get back above 78.5 somehow, then maybe we could see a short squeeze rally. But the longer-term time frame, this daily time frame, we've got a declining 50-day moving average below a declining 200-day moving average. The 10 and 20 are both declining, and they're both below the 50 and the 200 as well. That's what a bear market is. It's not down 10%. It's when when the markets are going down and the path of least resistance is lower and most stocks are lower. Now we could still get a rally back up to that level, and then most likely what should happen is that it will provide resistance and then continue the next leg lower. The little head and shoulders pattern we've been looking at in here, basically, let's just call it 84 to be conservative to 79. That would be 5 points. That still gives us a price target down near that 74 level. So I still think that 73.5, 74 looks like a likely area for this market to continue down towards. And this pattern of lower highs and lower lows remains intact, so there's no reason to think it's going to bounce until it can at least get back above this level. This 5-day moving average starts to flatten out like we saw over in here, but then that's what stops are for. If you buy a breakout like this, that's exactly why you have stocks. That's the value of technical analysis as well, is being able to find that market structure so that we can clearly identify what appear to be low risk entry points, like this might have appeared to be, but then coming up with a risk-reward ratio and saying, well, if this move fails, where is the support level that if broken, this market could be in trouble, and I'll set my stop, or right there. If you bought here and sold here, there's nothing wrong with that trade. If you bought here and you're still holding, you've got to re-examine your approach to the market because it's clearly flawed based on this action. Now, I'm a shorter-term trader, and a lot of the stuff that I do is based on day trades or a couple days, but that's the way I look at the market, and I look at the overall structure and say what's most likely to occur. Now, for some reason, it looks like Friday's missing on my daily time frame for the Qs. I don't know why, but again, here this just shows that 50-day moving average. I think a lot of people were looking for it to act as support. It was a potential level of support. It's an area where a lot of times people stop selling, other sideline money comes in, and it provides a bid in there, and it finds support a lot of times. Not all the time, though, and that's why you have to listen to the message of the market. The only thing that pays is price. Fibonacci doesn't pay, moving averages don't pay. They're great tools to help provide that overall structure for analysis, but they don't pay. Only price does. You have to listen to the message of the market. The message of the market, since it broke down below that 58.30, 53.80 level right here, was that this thing is busted. It's below this declining 5-day moving average. It continues to be below that declining 5-day moving average, and it makes this series of lower highs and lower lows. And it's really coming, it's really almost textbook downtrend where you see these prior levels of short-term support becoming resistance in here. This is, I could put this in a technical analysis book, and it would be a great example for years to come. Now, the market's clearly getting what many people consider to be oversold or down too much, but down too much is only compared to what? Not compared to what the next person is going to do. You're starting to see a lot of panic in this market. Hopefully, you've kept your powder dry, and maybe we're going to get some kind of turn in here. When we do get a turn, it's going to catch a lot of people off guard. I think that a lot of people have been looking for that, searching for that bottom, and if you're doing that, there's nothing wrong with that game. I've been, the last week I was putting some ideas on as far as, looking at the 1-minute time frame for short-term turn points. But again, in here, if you're going to play that game, buy that higher high. Why not? But then what? Then set your stop. Set your stop initially below this level. When it comes down, fails to make a higher high, and then it breaks to a lower low, there is absolutely no reason to continue to be long in a market that's showing this overall decline. I'm probably going to try and buy some kind of bottom tomorrow or the next day, to see if this market can turn maybe. But it's only going to be very short-term trades, and if I'm wrong, I'm going to be wrong for only a small amount. But if I'm right, I have a feeling that when a rally does come in this market, it could come very quickly, maybe taking us up to the 5-day moving average. I'm near 51.5 or so. That would be a tremendous rally, but it's very high risk trading in this environment, and I hope I've stressed that enough. And hopefully you haven't been really stung too badly in here.